Amazon this week issued $15 billion in bonds, which sparked more conversation about the ways in which all these big tech companies are going to fund their extraordinary capital expenditure commitments and the extent to which more big tech companies will turn to debt. For more on that, I want to bring on Paul Kudrowski, general partner at SK Ventures. Paul, welcome to TITV. It's great to have you here.
Hey, how's it going?
It's going well. I'm excited to talk about all things debt with you. I want to get your take broadly here. You know, the shift of the AI story being an equity story to a debt story. What is your sense of whether or not that's a good thing, a concerning thing, if it's a logistical thing? How do you sort of view that transition?
It's inevitable and it's wildly concerning. So it's both things at once. It had to happen because the cash needs, I'll say, let me put it differently, the perceived cash needs, and that's a longer story, with respect to this proposed build out, multi-trillion dollar build out worldwide of AI data centers, blah, 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 far exceeds the ability of these companies to do it from cash, despite them being prodigiously profitable in the hundreds of billions of dollars of annual free cash flow. But it was absorbing a larger and larger chunk of that. And at the exact same time, the opportunity opened up to partner and do sale leaseback structures and joint ventures and SPVs with private credit firms and other organizations, in addition to just selling bonds straight up on the bond market through investment banks. So once that opened up, it kind of was the meeting of minds where it's, well, we need all this extra capital and I don't want to do it out of free cash flow. And there are these, I'll say, generous people out there willing to partner with us to do this, so we'll use them. And then obviously, there's ancillary issues having to do with the ratings problems of having all that debt sitting on your balance sheet. So that's a secondary problem for now. Right now, it's just that it just exceeded their ability to do it from cash flow, and there were other sources.
Okay, there's a lot in there, not the least of which is the perceived demand, the blah, 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 and then the ratings issues. So we could double click on any of those. I am concerned, I am curious about the ratings issues that you see coming up, because, I mean, we look at these big tech companies. I mean, you could look at it and saying, well, these are hyperscalers, it should be pretty credit-worthy debt. Do you not see it that way?
Well, sure, but that's how the problems always start. The reason why you get loaded with lots of debt is because you were credit worthy and someone said, well, there's not a lot of risk in this lending decision. And then, of course, that spirals and on it goes. And so we're already beginning to see that happen. Look at what's happened with respect to some of the riskier debt structures like that's already on top of CoreWeave, or look what's happened with respect to the increasing debt at a company like Oracle, both of which have seen their credit default swaps, which is a proxy for how much it costs to insure them with respect to the riskiness of their debt payments, have both seen their credit default swaps climb sharply. CoreWeave's has almost doubled. Oracle's is up about 100 basis points. Doesn't mean they're insolvent, doesn't mean they're going to default. It's just a reflection of this radically changed world in which suddenly technology companies, which historically were unencumbered by debt, are newly much more risky with respect to this new debt load.
Now, you talked about credit default swaps. Where else are you looking for cracks here in terms of signals that, hey, things are kind of getting a bit heated?
Or just plain bananas. I mean, so the other place to look, obviously, is in credit spreads. So how much these companies are paying over what's nominally the risk-free rate, which is typically treasuries. So the credit spreads with respect to, say, for example, the Amazon issue yesterday was very, very tight, less than 100 basis points, 80 basis points over treasuries, which is basically saying there is no risk in this, which is ridiculous. And that at the same time, the tenor or the duration of the debt was 40 years, which typically you don't see from corporations, because who knows whether or not this company is going to exist in 40 years. So the notion that you have a tight credit spread on a 40-year note is frankly ridiculous.
Right. Now, let's talk about what the alternative is. I mean, the alternative is what? That we slow down the build of these data centers, and we slow down growth and investment. Is that sort of the solution here, or how do you sort of think about the alternative case to how this could have gone?
Well, sure. I mean, that's the obvious answer. It's no different than in any prior CapEx explosion, whether it was the global financial crisis or rural electrification in the 20s, the railroads in the 19th century. This is the same justification that's made every time that, well, if I don't do this, someone else will. And progress won't stop just because I think it's a bad idea. So onward we march. And of course, then all of these companies become laden with debt, and the failures become widespread, and they become self-reinforcing. As one fails, others fail. And the same thing will happen here.
Right. I do want to ask because you talked about the railroads and all the other technologies that we've seen that have required a lot of investment.
Uh,
As you think about NVIDIA, for example, and the mammoth of a position that it occupies in the AI ecosystem, are there any historical precedents for a single company occupying so much market share, so much mind share, being so dominant in a single resource? And if there are, I wonder if you've studied at all how those stories have played out and if that could signal what could happen with NVIDIA. Because look, we talk about AMD, we talk about the hyperscalers with their own chips, we talk about these chip startups, and really the story is, yeah, they could try, but NVIDIA is just it's so it's so dominant right now. Walk us through your thinking there.
Yeah, that's a dangerous narrative. And you can see that something similar happened in the mid 1920s with electrifications, where some of the largest electrical companies combined, no single one, but some of the largest combined were more than 50% of stock market capitalization at that period. Of course, that was an augury, a predictor of what happened in the late 20s with the crash of 29, because suddenly that whole process reversed. We'd vastly overinvested in redundant supply, and a number of those companies shrank, failed, and consolidated. I think the exact same thing is inevitable here, in part because we're making the same mistake of this naive extrapolation of future demand based on this anomalous period between 2017 and 2022,
Hmm.
when most of the demand at AI data centers was driven by training. Well, that's not going to be the case in future. We've largely exhausted the existing training corpus, so the future will not look like the past. So the predictors based on the past are all wrong. So you'll have the same kind of failures.
So now, in your role as an investor, how are you playing the market then with all this in mind?
We don't. I mean, I'm happy to be the beneficiary of cheap tokens, no different than I'm happy to be the beneficiary of cheap oil from the Permian Basin. But it doesn't mean I want to create a company that mines the Permian Basin for shale oil. It's the same phenomenon.
Okay, but tell us about some of the work you are doing. I mean, where do you see opportunity? What are you spending your day to day looking at as exciting opportunities, if not AI and sort of the
No,
underlying
I
debt that
mean,
you talked?
AI is terrific. It's just I don't want
Well,
to be on the
eh,
side of exploring.
right,
I want to be on the side of. So for me, the bubble is about CapEx, not about the
right,
technology.
right.
Specifically, then imagine, just for the sake of argument, that AI data centers are vastly overproduced, which causes token prices to collapse further, which means they get to the level of kind of marginal cost, right? So power, light, and water. That's really all they can cover anymore, not even debt. So that price tokens are so cheap that you waste them with, impunity. And then you think about it in the context of organizations using models for doing things like reconciling suppliers, really mundane, boring things where I'm trying to bring on new suppliers and match data patterns up. This is not exciting stuff, but it's the stuff where if I can waste huge number of tokens for free, I can make the real world life of organizations much more efficient. It's not going to get me on the cover of magazines, but it is going to save me money. So that's the stuff we're interested in.
And it'll get you on TITV, I'll tell you that much.
Hmm.
Last question for you. As you think about all the risk that is building up in the system, is there any role for regulators to play here? Are you hearing any conversation of the way they're thinking about this?
No, they're mostly confused. So what they end up doing instead is mostly thinking about these as the factories of the new industrial revolution, as I keep hearing. And so it's this idea of promoting that not only must you have more data centers because they're the new factories of the industrial revolution, but we're in an existential battle against other countries and we must win. When you put those two pieces together, you get some of the largest bubbles in history.
Largest bubbles in history. Okay. Well, I think that's a good place to end it. And of course, we have NVIDIA earnings coming up tomorrow. And
Yep.
so as people say, the market is what is it? One NVIDIA earnings miss away from a recession, I think is where
Yep.
some people land. And so, hey, Thursday, we should, maybe we'll have you back on again to see how the market is reacting. Thank you so much for coming on. We really do appreciate it.
Sure. No
We'll
problem.
talk to you again soon.